Okay, well, hello everyone. This is the final piece of chapter 6, dealing with revenue recognition, which it's a very dense chapter, as I think I mentioned to the class in subsequent prior videos. That it takes a bit of time to get through it. There's a lot that's going on here, and I again moved the due date for the quiz from Friday to Sunday, just so that we could sort of go over some of these. If you have questions, feel free to get with me regarding any of the course content or any of the course matter for that matter. Okay, so when we talk about this, and it should be chapter 6. It looks like something's outdated in the slide package, but it is chapter 6. And we're the final piece of this, part C, which deals with accounting for long-term contracts. And we'll talk about the revenue recognition issues here, how we recognize revenue over time, and what some of the complications are there, particularly when it comes to cases in which the costs are going to be different than what we as the provider are anticipating. And again, construction is sort of the exemplar that we use really when we talk about revenue recognition, especially over long time periods. And so if we go back here, you notice that we talk about steps 2 and 5, and where do those come from? We go all the way back, all the way back, all the way back here. And there are some steps involved in revenue recognition. And it goes like this: identify the contract, identify the performance obligation, determine the price, allocate that price, which is a big issue, and then also recognize revenue when or as each obligation is satisfied. So if we're talking about long-term contracts, that is, those which are going to cover more than one accounting period, which is really what the definition of long-term is, we really need to understand how to recognize revenue over time. And by recognizing revenue, we can also do a better job at communicating to external users what the actual performance of the organization is, and also to recognize profit as it's being earned. So in this case, step 2 is identify the performance obligation. Usually, and we're going to sort of make this into one performance obligation. I think we talked about this earlier, the idea that there may be a lot of different tasks and activities involved with this, but the best way to segregate this out from other projects, because keep in mind, some companies may have multiple long-term contracts going on. The best way to do it is to simply identify each individual obligation as it's being done. In other words, a performance obligation. Okay. And then step 5, recognize revenue when or as each obligation is satisfied. And we'll talk about it either from the standpoint of progress toward completion, that is over time, or upon contract completion. And this is the area that we're going to focus a little bit more on here and talk about the idea of what are the differences, some of the pluses and minuses of doing that. So in this case, we have this, our example throughout the text in chapter 6 is as that of the Harding Construction Company, and they had a contract to build an office building for $5 million in 2021. And so it begins in 2021, ends in 2023. And the final price, that is the final amount paid to Harding, is going to be $5 million. And we're assuming there's no way for the contractor here, Harding, to change the price due to cost overruns and whatnot. So this is one of the risks of long-term contracts, particularly when there's no ability to deal with things like cost overruns, materials price increases, things like that. So as a result, it becomes tricky. It's very dicey sometimes on the part of contractors engaging in these long-term contracts. So particularly when they're having to bid against other suppliers who may be trying to undercut them, and there's always a risk in whoever's doing the contracting, whoever the buyer is, in trying not to go too low, because maybe that particular contractor is overly optimistic about their particular chances of getting it done on time and under cost and whatnot. So these are all the long run risks. But nonetheless, what we're interested here is in talking about how we recognize the construction costs. And so we've got the cost laid out here, and it's going to, and the anticipated cost will be $1.5 million in the first year, $1 million in the second year, $1.6 million in the third year. So altogether, $4.1 million as the estimated construction cost over that particular time period. Obviously, between 2021, which is the beginning year, and there's no cost being carried over, but it is cumulative though from year to year. So 1.5 million carries over to this next year, and so the cumulative construction costs as of the end of 2022 are $2.5 million, and then that itself then carries over to 2023, and where we end up with the final estimated completion cost of all the inputs of $4.1 million. And notice that because 4.1 is the figure that is being estimated here, as of the end of 2021, it looks like there's 2,250,000 left in new costs to be incurred as it goes along. And then these costs are expected to go down all the way to zero because those are the costs that are yet to be there. And this plays a role in terms of recognizing revenue because of this idea of the percentage of completion method, which is really the sort of the heart of what we're doing in revenue recognition. So total costs are estimated to be these figures in the red there. And then there are billings, and we'll talk a bit more about billings and why that's an important account. It's really sort of a way to be able to create a receivable, frankly. Otherwise, you'd have a lot of problems with doing the actual billing. And we'll talk about where sometimes these are current assets, sometimes these are current liabilities, depending upon where the percentage of completion actually is and what the billing schedule is that's approved of ahead of time. And a lot of times, and again, this really sort of lends itself more to construction, specifically as a form of activity, because usually there's a what we call a draw schedule in which companies will bill. There's a billing schedule, and sometimes when we say draw schedule, we're also sometimes talking about financing, but usually those are attempted to be coincide with one another. But billings are an area that we'll talk about here in a minute. Those either belong in the current assets or current liabilities section, depending upon the overage or shortage in terms of actual completion. Then the cash collections during the year, which again, in accrual accounting, cash collections are less an important issue. Obviously, it becomes an issue if the collections are expected to be deficient for whatever reason. And we certainly talk a lot about that, particularly as we get going forward in terms of in chapters, the next chapter we're already talking about. Okay, so these are some of the journal entries here. And these are what we would call aggregate journal entries. These are not one single journal entry. These are sort of the accumulation of all the journal entries that relate to these particular activities for 2021, 2022, 2023. And since the project spans multiple accounting periods, revenue is going to be recognized and also allocated over the period of the construction or the performance obligation, as we say. And so in order to record construction costs, we'll eventually have an account receivable. Where does the receivable come from? It basically comes from the fact that we're billing on construction contracts. And sometimes these receivables are greater or lesser than the actual billings. And as a result of this, we have to sort of net those out. Over time, that billings account, when the project is complete, that billings account will totally go away. And as will another account here called construction in progress. Construction in progress can easily be thought of as analogous to work in process in a manufacturing context. And for those, I think you've all had managerial accounting as well as hopefully the cost accounting. And if you haven't had that yet, what it really is simply the value of the work that's underway. It's not yet ready, and of course we say that in financial accounting that the work is actually owned by the buyer, and so as a result, the buyer has control over it. Presumably, maybe I guess the buyer can tell the seller to stop doing the work, particularly if there are some quality issues, which we really don't have the ability to record adequately here. But the idea is that in order to transfer this asset, the buyer has to have control over it. And so as a result, construction in progress is a not yet completed asset. But it is an asset nonetheless, so it's a debit balance account, okay? And then the expenditures are in credit balance for cash, materials, and all that. Again, these are not individual transactions. These are accumulated sort of aggregate transactions to record those costs. And in terms of the billings, we're billing based upon some predetermined billing schedule, and that's agreed upon between buyer and seller ahead of time. And I think buyers understand long-term contracts that contractors have workers to pay and materials to pay for, and nobody wants to wait. Certainly not workers. They don't want to wait for some completion of a contract in order to get paid. Clearly, and so as a result, there are expenses that need to be funded over a shorter time period than the completion itself. And so as a result, billings are made on a periodic basis. But the big question is, how do we recognize revenue over this time period? And then how do we recognize profit that might result from that revenue? So when we get to this idea of revenue recognition, the general approach is basically this. We have this idea that construction costs are recorded over time. And this is the one, when we say general approach, this is where we are looking at the end of the project. This is at the completion of the contract. And so this top method here on the screen recognizes revenue at the completion, while the bottom illustration, these are two different approaches. These are not one approach. They're two different approaches being contrasted. The bottom records revenue as it's earned, but yet the same revenue and cost for that matter recorded in the end under each method. However, they report revenue differently over the contract period, simply because of the fact that in the end of completion recording is the idea we post the revenue $5 million and we have $4.1 million in terms of cost of construction, and as well as construction in progress. By the way, the construction in progress really represents the profit from this particular transaction. Now, it will go away. It will zero itself out because the fact that the billings will also have to zero themselves out as we create receivables from that. So you might want to make sure to look in the chapter about this and sort of follow what's going on with regard to this idea of progression from billings to receivables. Billings are simply a way that we can sort of accumulate what has been actually charged to the buyer in this regard. Okay, so that's the top method. Now, this is not preferred. Instead, the better method is recognizing revenue over time according to the percentage of completion method, where we have construction in progress, but also notice that we have revenue being earned over time, the 3-year period. And they add up to $5 million because that was the agreed upon amount, but it's spread out over that time period. And as importantly to this is the idea that profit is also being recognized, because not only are we accruing revenue and posting revenue to the financial statements, but we're also posting expenses as well. And then by implication, then the income statement is going to report a revenue figure for those periods of time. Whereas with the single method where we report everything at the end, it's going to be distorted because everything comes at the very end of the project. And so really, if you're a public company or any company for that matter, I guess, it's going to be a distortion of what the performance is going to be if you use that top method there. So the percentage of completion method is the best way to go. Now, obviously, and I think I alluded to this a second ago, they're both going to get to the same place. But we can say this about a lot of things in financial accounting. We can talk about different inventory methods and say, well, FIFO and LIFO will in the end get you to the same place. And maybe that's a true statement, although it may be a very long time period and whatnot. But there are different ways of getting there. The question is, how do we adequately reflect what the performance of the firm is if we're the accounting staff trying to prepare financial statements for users to understand what's going on? And so on the left side, over time is a much more realistic way of doing it, because otherwise in the first 2 years, it could very well be that the company's reporting a loss, when in fact they're not really incurring a loss. They're just reporting a loss simply because of the way that it's being reported. And there are a lot of these instances throughout accounting in which we have distortions in reporting if we use one particular method versus another method. Okay, so the recognition upon completion does this distortion over the long time. We get to the same place, but notice that if we talk about construction in progress, we're going to get the same dollar figure at some point here. So the best way to do it is reporting over time. And so the percentage of completion method, which is a very, very common technique used in long-term contract accounting, it's usually, well, actually, okay, let me just say this. There are different ways to do it. You could do it on a revenue basis and look at and so we think of revenues, we think of the value of outputs, and so we can look at that in that direction. The problem with that is that not all the outputs are uniform, and it's sometimes really hard to account for these outputs and say, okay, we're 40%, we're 60%, whatever the way done, because sometimes there's a lot more effort expended in certain areas than other areas, and so it's a little bit trickier, and it's not really the best way to go. Instead, an input-based method, which again, inputs create costs, is a little bit more, well, not a little bit, it's much more accurate. And so in this case, if we're talking about using inputs, what we're doing is we're trying to track costs, and we're sort of associating that with the percentage that's completion that's been done. And then that translates over to the revenue side. We'll give some examples as to how that works. And so the revenue recognized in a particular period, whatever it is simply estimated revenue times the percentage completed to date, whatever that is. And again, the cost-to-cost method, which is more of an input-based measure, that is, we expect this thing to cost 4.1 million if we expended 2,050,000, that's 50%. So we would multiply that times the estimated revenue minus, because this is a cumulative measure, what we've already recognized, because we obviously can't book revenue twice. We have to take out what has already been there, and that's one of the issues, and something that is comes up all the time in homework and quiz type scenarios, where we have to take out the revenue recognized in prior periods, because this is a cumulative long-term sort of situation. So we have to kind of go in that direction. So in this case, we're going to look at I'll blow this up a little bit here if I can, just a little. I don't think I can actually. Well, maybe I can. I know sometimes this is hard. These screens are hard to see. And oops, went the wrong way there. So I do want to sort of make them easier. All this is obviously your text. There's nothing new here, but so let's take a look at these. Oops, that's too much. I knew I was going to make a mistake there. So okay, so there we go. Oh, all right, so recognizing revenue. I don't think it really helped anything, but all right, well, I did what I could. So all right, so you got 3 years of this construction contract. We get the costs incurred. We already sort of talked about that. Costs incurred during the year. We're expecting to 1.5 plus 1 is 2.5 plus 1.6 is 4.1 million. That's the final cost upon completion. And so as a result, if we think about the fact we got this much remaining over a 2.25, 2.25 million, and the total contract cost estimated plus actual is 3,750,000, then we simply take the contract price times this percentage of completion, which is what? It's this figure here, actual, divided by the total cost that we think. Now, by the way, these costs may change over time, and that's something we just have to kind of deal with. And we're going to come back to this a bit later when it becomes a little bit more critical and disheartening, particularly when costs get out of whack. But we're talking about 40% is the percentage of completion based upon what? The cost method. And so as a result, the total contract price is 5 million. 40% of that is going to be 2 million. So we'll recognize $2 million in the first year. And then we do the same as we go on for the second year, 2.5 divided by 4 million, which is the amount that is expected to be completed. Obviously, this will make its way to 4 million at some point, or 4.1 million. 62.5% of 5 million is 3,125,000. This is cumulative, so we got to take out that 2 million that we had before. And then we're going to go all the way across here. We're going to work our way to $5 million as we do this. And so in the final year, obviously, we're going to be done. And the final contract cost is going to be 4.1 million. Again, cost and price are two different things. And this is something that a lot of us harp on and emphasize to the point of exhaustion. But costs are usually internal matters to sellers, to the firm under examination, while the price is the exchange value of this particular good or service being provided between buyer and seller. So I think we have to kind of be aware of that distinction as we sort of progress in this area. Okay, so that's essentially where we get these percentages. And so if we go on then, so remember we are talking about there we go. So the cumulative revenues, remember, it just kind of goes back just to the prior screen, really. 1.5 million, 2 million, I'm sorry, 2 million, bottom line here, 2 million, 3.125 million, which is basically the difference between that and the 2 million prior. And so we have 1.125 million, and then the final amount, 1.875 million, which is this minus this. So when we talk about the difference between year 1 and year 2, it's this minus this. Between year 3 and year 2, it's this minus this. And so as a result, we get these dollar figures here. And by the way, they're also expressed here as well. And these are the journal entries in terms of revenue being earned as we are using this particular approach. Okay, so these are the numbers that we plan to be posting over time, especially if things are more or less on track with what we think they're going to be on track. So I have a lot of my mouse keeps jumping around here a little bit. So all right, so those are the figures there for revenue recognition. 2 million. We're looking at this line here: 2 million, 1,125,000, and 1,875,000, and that then takes us, add those all up, and they should be $5 million, right? Okay, and then to recognize revenue, then again, we're looking at construction in progress, which again is very similar to work in process in the form of like in the manufacturing context where we're making goods. These goods are not yet done, they're not ready to be delivered, but nonetheless they do represent assets. And again, we oftentimes, this is something that is a feature of managerial accounting, and it sort of brings itself over to here, is the idea that we capitalize a lot of costs. In other words, by capitalizing, it means we put them in an asset account, not as an expense. We don't expense them in that particular period. We're simply capitalizing those. And so as a result, and some will be, over time, it's going to work its way out to earn a profit as hopefully revenues being greater than expenses. Otherwise, we've got sort of a problem. But this is the revenue recognition over time. And the construction in progress is simply broken out here as the end of those accounting periods as to what is estimated in terms of what's going on. And this is where accounting can play a big role in terms of trying to estimate what these figures are going to be as we go throughout the process. Construction, or any kind of long-term project for that matter, is a tricky business. And I can tell you, I've had a lot of clients over time that some did extremely good work and some did extremely poor work. And it was really difficult to sort of figure out what the heck was going on, mostly because it does require lots of good accounting. And maybe even more important than that, maybe even more important than doing the actual work itself, is trying to determine what the revenue is going to be earned over time, what it's going to cost, and can we complete the work on time and under budget, all that. So these are all issues that come up. And so long-term accounting for these is a little bit tricky. And it's often the case that we sort of miss the mark, sometimes by a wide margin. And if we miss the mark, hopefully we miss it in a good way as opposed to a bad way, meaning that it adds to net income as opposed to detracts from it. So in this case, this is profit recognition. We talk about revenue recognition. We're actually going to be booking profit in these 3 years under this particular method. And obviously, either way that you do it, whether it's over time through the percentage of completion method or at the end of the project method, you're going to get the same dollar figure, assuming all else remains the same with all the facts that are the same. But this is a way that we can report actual net income from what's happening. And by the way, it's not like the firm has got the seller in this case has got to finance all this up front, because they are doing periodic billing, and so there is some cash flow being received. So it's not a case in which we're building a hotel or a casino or whatnot, and we don't get any kind of receipt of funds for 5 years or whatever, or I guess 3 years in this case. There are funds being received over time. And this kind of flows with the idea that in order to better account for that, we do need some method that does account for that. So in this case, and again, some of these slides are a little bit redundant here, frankly. The idea that we recognize revenue, $2 million, cost of construction, this is 2021, of 1.5 million. So as a result, we have gross profit. So now it's not just revenue recognition, it's also profit recognition. But we can't get profit recognition until we have revenue recognition. And so as a result, the method that we would use as preferred method is to do this based upon the percentage of completion method, a very widely accepted methodology. And so we go to 2022, we have the total amount there. And then we get to the final year here, which is 275,000. So as a result, we end up with the same $5 million. Now, here's the question. Okay, that's the revenue earned, assuming everything goes according to plan, right? And that's not always the case, but assuming everything goes according to plan, we're going to recognize $5 million in total revenue. Well, what about the construction in progress account, which again is an asset account? It's really like an inventory account. It's not really inventory because it doesn't really sort of meet the characteristics of inventory, but it is an asset. So, and an asset's got a debit balance. And so why are we crediting this? We're crediting it to take it off the books. This contract is done. So this accumulated aggregated amount of construction progress is going to go away. And again, these are aggregated accounts over the long time period. And then the billings account is also going to take this out. So these will cancel themselves out. They will zero each other out because that project is done. Okay, so construction in progress, it's no longer in progress, and so we can't call it an asset. And we use the billings account because if we didn't do that, then and we created a receivable just out of thin air, then we'd really be sort of double counting the amount of the asset that's been produced at that particular time. And so we don't really want to do that. So this is where it gets a little bit tricky when we talk about billings and what we do with the billings account. We just can't create a receivable by saying, hey, it's here's a receivable, right? And it's going to have some sort of offset. And this is really what we're going to be sort of leading into here and talking about it. And we talk about billings. The billings account has different balances depending upon what specific method is being used to recognize revenue, but the specific billing schedule makes these entries necessary. And by the way, you can have a case in which the costs are in excess of billings, and so as a result, you've got a different figure here, or you've got different cases in which the billings are in excess of costs. Okay, if the costs are in excess of billings, then essentially means that's called a current asset. Why? Because remember, think about all the way back to Principles 1, where we talk about what an asset is. It's something that was created, it's a resource, it's a benefit created as a result of past transactions and which has future service value. And so as a result, we've incurred more cost than what we build. So we've got $300,000 coming to us. We just haven't created it yet into a receivable, but we will, based upon whatever the schedule is. Maybe it's not time yet for us to bill because the billing schedule is agreed upon ahead of time. And so whatever the contract agreement is, maybe it's not time yet. On the other hand, what if we have billings in excess of costs, where we've billed more than what we've actually created yet? And as a result, this is a liability, and a current liability. Why is it a liability? It's a liability because what is a liability? It's an obligation to perform as a result of some past transaction. So it's a claim against the firm. In this case, Harding Company has a claim against it because of the fact that we've billed beyond what we've actually produced. But again, we're entitled to do it if the billing schedule allows for it. And we're assuming there are no qualitative issues with regard to this, and we could bring in hundreds and thousands of different wrinkles and twists to this, which may impact this. But in general, this is really what we're talking about, is the idea that one can be a current asset, one can be a current liability, simply because of the fact that we've got different things going on. Now, this top notion that I talked about was this idea that we've got upon completion, but it can also be the same case with revenue being recognized over a period of time. And so in this case, there's not that much difference in terms of these, the schedule. It's just simply a timing issue, right? And depending upon where we are in the construction process, what our billing schedule is and whatnot. And as things are being produced, people are watching it, everyone's sort of paying attention to what's going on. So hopefully this is not too much of a distortion of as to what's going on with the actual economic performance of the contractor, i.e. the firm here, Harding Company we're using, okay? But this is the balance sheet, right? These are balance sheet accounts, right? At the year end, these are adjusting entries that need to be made in order to be able to reflect what's happening. And again, if you're a company that has lots of long-term contracts, and your text has got lots of examples of different companies like Boeing and big construction companies and companies that do lots of long-term contracts, they've got all these reported on their balance sheet, and they will be carried over to that based upon where they are, what the status of it is. Okay. All right. So a quick question here is Robertson Construction entered into a contract. Construction sort of seems to be the theme here. Entered into a contract to construct a tunnel for a fixed price of $12 million. And we're going to sort of carry this example through a lot of different iterations here. And so they recognize revenue over time according to the percentage of completion. Here are some of the facts. We've got the same years involved: 2021, 2, and 2023. Costs incurred with an estimated annual additional cost to complete. So what is the percentage of completion as of 2022? All right, well, we're going to use this sort of cost method here, and we're going to see where we are. Well, as of the end of 2022, we've incurred $3 million in the first year, $500,000 in the second year, so that's $3.5 million, divided by the remaining amount yet to be completed. So $3.5 million divided by $6.5 million is going to be at 35%. Okay, and that's I'm sorry, it's not $6.5 million. It's $3.5 million plus 6.5 million is 10 million. So 3.5 million divided by 10 million, I'm sorry about that, is going to be 35%. The price of 12 million again is the amount coming to them ultimately over this 3-year period, however they receive it, but on a cost-to-cost issue, cost-to-cost method where we're taking current costs, cumulative cost divided by total cost is 35%. Okay, and we're going to be sort of flipping back here as we get going. So some more examples here, and this is a pretty good example of what's going on. Again, we're not getting into the journal entries or income statement presentation or anything like that, or even balance sheet presentation. All we're simply doing is we're sort of tracking the percentage of completion in order to recognize revenue. So, all right, so same facts, and so in this case, what's Robertson's percentage completion in 2021? Well, all right, so it seems like these are a little bit out of order, at least I think so. We did 2022 first, now we're going back to 2021. Well, it's 3 million divided by the 10 million, so it's 1/3, right? So pretty simple deal there. So that's really all it is. That's the percentage that we would apply then to revenue as we go forward. So remember, the percentage of complete, what we're trying to get to is the idea that we're trying to get to percentage of completion to recognize revenue. So all right, so let's see here. As of 2022, what is the percentage completion? That is, we have $8 million. That's 3 plus 5, right? Divided by the $10 million, and so 3 plus 5 is 8 million. Divided by 10 million is 80%. So okay, and we're going to sort of take this and go forward. How much revenue Robertson recognized in 2021? Well, we got to go back here, and we're going to go back to 33 1/3, right, which is 1/3. So as a result, what are they going to recognize? Well, it's going to be it's essentially going to be this answer of 1/3 of the 12 million. Now, here we're taking cost that is cumulative at this particular point in time times the total completion percentage, right? And that's, or I'm sorry, cost as a percentage of total completion cost altogether. That percentage then is multiplied against total revenue. Okay, now this is 2021, it's the first year, so we don't have to take out any revenue that's been earned before, but we've earned essentially $4 million. Why? 1/3 of 12 million has been earned as of the end of 2021, which we already calculated. That's what the previous exercise was all about, was first of all, what are these percentages that we're going to be looking at? And then taking those percentages and multiply it by the expected amount that we're going to get in terms of total revenue. Okay, this allows the firm then in 2021 to report a revenue which presumably exceeds the cost of production and therefore records a profit in that year, even though the project itself is not done. So remember that this is one of the exceptions to revenue recognition, in the sense that the good is not really all done yet. It's not substantially complete, but we're on our way to doing it. And it's a better way of doing it than simply saying, well, at the end of the day, 2023, this is where we're going to go. Okay, so for 2022, how much revenue would Robertson recognize? Well, we're back to that percentage here where we have 80%. So 80% of the total cost is going to be 80% of 12 million minus the amount that's already been received. And so it's going to be, we're going to end up here, the amount's going to be 5.6 million. Why? Because 80% of 12 million is 9,600,000, right? And we're only 80% of that. So the amount is going to be 5.6 million as of that year. And then at the end of 2023, it's the rest that remains. And so it's the 12 million minus what's already been recorded, 4 million. That was in the first year, 5.6 million. The second year minus 2.4 2.4 is the residual, and that we earning that final bit in 2023. That's the last year of the project. And so we've finished the project. It's done. We've zeroed it out. We've gone down the road, and everything is fine and dandy, right? And obviously there are difficulties with construction accounting, and there are entire books on construction accounting and accounting for percentage of completion method, and all the difficulties that arise as a result of that. So again, this is really sort of introduction to this whole topic, but it does sort of give you an idea of how firms recognize revenue over a period of time so that they can better spread out those revenues to recognize them as they're being earned, not as the payment is being received, because that would really be sort of a violation of accrual accounting concepts if we're only following the money. And again, we're not following the money, we're following the economic activity, and that's really the heart of what accrual accounting is all about. Okay, and I think one of the last bits here of chapter 6, and again, it's a very lengthy chapter, is this idea of losses. Now, nobody likes losses, but they happen. But sometimes they're only a short-term loss based on where things are at the current level of completion of a project, or sometimes it's an overall loss, which is probably, well, certainly is worse. And over time, those sellers, that is the providers of whatever the contract provisions are, have got to update their estimates and recognize that sometimes there are losses that go on. And this is where it gets a little bit tricky. And among all the difficulties that are inherent in long-term performance obligation and accounting for those is the idea that sometimes things change and we have to update things as they go. A lot of these costs, frankly, are outside of the control of any individual firm. And if you follow business firms over long time periods, you'll see very often where management will explain in financial statements, "Hey, we couldn't control the price of the cost of these inputs, and they're out of our control, whether it's energy costs or interest rates or whatever the case might be." All these are things that sometimes complicate the work or complicate the strategic planning and the overall profit planning of an enterprise. And so in this case, all right, so we go back to our example. The contract price is still $5 million, but it looks like we have an increase in cost of $4.1 million, which was the initial projection, to $4.6 million. And so as a result, now everything sort of changes, and you've got a different percentage of completion based upon this cost to cost sort of measure. So as a result, we are going to be slowing down our earning of profit and our earning of revenue, for that matter, based upon these cost overruns, or whatever you want to call them. So at the end of 2022, it looks like we had $2,760,000 in cumulative costs. That was higher than what we were previously. I think what were we early? We were something like $2.5 million, I think it was, right? So, and yeah, I think it was at $2.5 million. So we're at a higher figure here. So if we divide that by the $4.6 million, this is a new figure here, right? We're only at 60% completion. So as a result, the revenue is going to be still $1 million, as opposed to because $1 million. So remember, we had 40% earned in the first year, but now things have changed in year 2. So as a result, $1 million now brings us to $3 million of the $5 million contract. So as a result, we're only recognizing $1 million of revenue, but guess what? We've got costs that have exceeded that. And so in 2022, we have a change in estimate. Now, this idea of change in estimate is an important one. It comes up again and again throughout accounting, and it's one of the problems that accountants have to face and management has to deal with, and that is, when do we recognize there's a change that's material and we have to sort of change our estimates? Nobody likes this. This is not a good outcome, but it happens, right? So notice the construction costs in that year, the debit balance, which is an aggregate of all expenses in that particular period, 2022, exceed the revenue from that period. So as a result, well, that's not good, right? So, but it happens. These kind of changes in costs do occur. And the rule is, if once management recognizes that these costs have changed, then they should report it. And there are lots and lots of instances in accounting, both in GAAP as well as international standards of reporting, where once management knows something is changed and is materially different, then they have to report that and make note of it. And if it's large enough that it's going to impact profit, then sometimes companies are really expected to report that as a sort of interim statement to the world that, hey, we're not going to make our profit projections and whatnot. And this gets us into finance, where companies that report earnings on a quarterly basis, and right now we're still reporting on a quarterly basis. There's been an effort to try to move this to semi-annually, but companies that they recognize at some point they're not going to make their profit projections, will do what's called profit warning. It's simply an announcement. Typically, the stock price takes a nosedive, depending upon how severe the issue is, and whether or not there's a feeling that maybe it was not going to be a full story, or is going to be a full story, whatever the case might be. So it's a negative event, no question about it. Nobody wants to lose money. It's not what business is there for. And nobody wants to lose money on particular individual projects, but it does happen. And sometimes these project financing is complicated, and sometimes companies do lose money. And so this is just an eventuality that has to be accounted for. And the earlier that is reported, the better. And so in this case, we have an unprofitable project, and this is upon project completion. We're still going to report the 4.6 million. There's not going to be any sort of change with regard to that, and everything is essentially the same, except that we are going to be losing money for this project. What we're more interested in, though, is on the entire project itself. In this case, what do we have here? Well, all right, so let's kind of do a bit of a dive into this and see what's going on. So overall project costs are rising above projections, and so as a result, gross profit in the first year is going to be 500,000, but now we have losses for the next 2 years of, in aggregate, $700,000. And so remember, at the outset, we expected to earn 900,000 from this project, but now it looks like we're going to take a $200,000 loss, and so it actually goes in the other direction. So it's just something that has happened here, and as a result, assuming that we can't do anything about revenue, right? Now, some contracts will allow for cost overruns, particularly in some government contracts and whatnot, where you can get an approval to sort of recalibrate the revenue, but we're assuming in this case that's not going to be the case. And so as a result, we know even as of the year 2022, we're even over the contract price here. So, but the contractor is sort of locked into it, and there's apparently in this example no way to sort of deal with the issue. And so as a result, total project loss is going to be 200,000 as opposed to the initial profit. So, and that's just kind of the way this whole thing works out, and it just is something that has to be sort of dealt with. And so, all right, so in this case, all we're really doing here is the journalization of these. Let me see, where do we end up here? Okay, here we are. So, yeah, $200,000 loss. And so, and these are the differences in the contract cost. And when 2022 was the year in which this particular contractor experienced changes in cost for whatever reason. We don't know what's behind this, but we just know that these are rising costs. And so as a result, in terms of journalizing this, remember the first year we had a profit. It was the second year that really became problematic. And then we had a $600,000 loss. Not a profit being recognized. We recognized revenue, but the revenue percentage actually went down simply because the cost-to-cost method that was used here was based upon the percentage of completion. An input-based measure, the cost measure, turns out to have been a bit lower. We recognize a little bit less revenue than what we had anticipated, so we have a loss for that year. And then, let me see here. And then we get to, oops. My mouse is kind of all over the place here, so I'm trying to, my mouse kind of moves around here. So, and then we get to the end where we have an actual loss being written. And for whatever reason, it doesn't look like they journalized the issue here for the last one, but you kind of get the idea. So we have a loss for the entire project. So that's essentially what's going on. So, and over time, this is what is being recognized, is the fact that we have a loss really beginning in 2022, carrying over to 2023, and as a result, the project is a loss. And so we have to recognize that when we know that it's going to be a loss, and there's really no good way about it. So, and over the time period, this is what it sort of looks like here. You got cost of construction, you've got revenue for long-term contracts, which is a credit balance account. This is actual revenue being earned here. Construction progress, right, is being taken in. Now, again, we credit that so we can create a receivable, right? And that's what's going on. And as your text talks about the idea that how do we create receivables in the first place, is we have to create a sort of a billings account in order to do that. So we have to create that sort of intermediate account. It's a very temporary account that allows us to, in order then to create a receivable, because we can't just create one balance, a debit, without some sort of offsetting credit somehow. So we have to do that. So as a result, we have those kind of things going on. So, okay. All right, so for the entire project, we end up with a bit of a loss here. So the journal entries to record these are for 2022 and 2023. Again, we have losses in the first year. And again, losses are simply You know, and by the way, when we talk about journal entries, we're talking about closing the books for 2022, where we're going to have a loss on this particular contract if we're assigning all these costs to individual contracts themselves. And so it's obviously a loss is always a debit balance. It's an income statement account. That's a loss. And the offsetting credit is construction in progress. And then at the end of the day, we're going to zero out the entire cost of construction or construction in progress. And we recognize the revenue over the time period. This is upon the entire completion, and construction in progress is also zeroed out. So this particular work is done. This yes, we have a loss, not good. It does happen, but this is the completion of how we would sort of wrap up this particular activity. Okay. All right. Well, that was the final bit I wanted to record for everyone, just so everyone's got sort of an updated bit of commentary on this. Feel free to contact me if you have questions about really anything in the course, course content, course schedule, and whatnot. And again, as I'm doing these as classes go on, Tuesday, Thursday, and whatnot, I'm updating the syllabus, and I like to sort of push things back as long as possible. I know that some people like that, some don't, particularly since we push things back and sort of load up in the weeks of exams. But this is where sort of pacing yourself and budgeting your time really is helpful in that regard. So when we come back on Tuesday next week, we will do some more in chapter 7. Hopefully we'll get through the rest of that on Thursday at the very latest, hopefully maybe halfway through the class session, and then we can open the door to get going on further. Remember, from here on in, what we're talking about the rest of this particular course are really balance sheet treatments. But again, balance sheets articulate with income statements. And so we can't, just like here, we've got income statement items, revenue, expense, and but it's going to focus mostly on first the current assets, which we began talking about in chapter 7, cash and receivables. And we'll kind of go on. Chapter 8, we'll deal with inventories, which is always an important area in intermediate accounting, particularly the first course of intermediate accounting. Okay, so I'll say goodbye right now. And again, if you have questions, feel free to reach out.